This is our first video lecture in topic 4, which deals with two of our financial statements, the income statement and the statement of cash flows. We're going to begin by reviewing the income statement and then moving on to the statement of cash flows in later videos. We're going to break down the videos for each of these statements into smaller components so you can review each component separately. Let's talk in general about the income statement. The first thing to note is that the income statement covers a period. In the last topic, we looked at the balance sheet, and the balance sheet is a snapshot in time. It is as of a certain date. The income statement and the statement of cash flows cover a period. This income statement, like most, is comparative in that it presents 2 years' worth of information, 2011, the current year, and the prior year. Why? Well, because one set of data by itself does not make for a very good comparison for decision making. So we serve the users, so we provide comparative information. You'll also notice this format, like most, is a single column. It runs from the top down. Each year is in a single column. Some of the examples you'll see in the textbook will have multiple columns. And the other thing to note that this is a multi-step format, and that we provide very detailed information to the users as opposed to a single step, which does not provide as much. Most companies provide a multi-step income statement. Why is it multi-step? Well, because it's going to give us a number of key subtotals. The first one is going to be gross profit. The next one is going to be operating income. And then finally, net income. So in a multi-step, there are multiple steps. To arrive at net income. Now, the income statement is typically referred to in a set of financial as a comparative statement of operations. Again, comparative meaning the 2 years, statement of operations showing the results of the operation, how the operation has changed the financial position of the business. I'm calling this company the kitchen sink because as we go through the video, we're going to be using this as our demonstration, and this particular income statement contains just about every type of situation that we'll come across when we're putting together our income statement. Before we move on to our first step in this multi-step presentation, let's talk about this, the earnings per share, probably the most widely reported number from financial accounting. And you'll notice that in our multi-step presentation, our earnings per share is not given solely for net income. We have an earnings per share that results from something called continuing operations before extraordinary items, something called discontinued operations, and something called the extraordinary loss. We'll be looking at this for each of these line items in subsequent videos. But let's start off by looking at the first step, which is the calculation of gross profit. This is the first step in our multi-step income presentation. And let's begin with looking at the first element that is presented, and that is sales revenue. But notice that we have what is termed as net sales revenue. So, what is included in sales revenue? Well, sales revenue increases through a credit to sales revenue. And as we'll see both in Chapter 5, which is our topic 6 for this course, and in Chapter 7, which is topic 1 for intermediate, there are a number of allowances that reduce the gross sales that were recorded in sales revenue to the net sales that are being recorded on the income statement. This is an allowance for returns. Notice that kitchen sink, their year ends on January 31st of each year. This is quite typical in most companies. Retailers, for example, will not end their year on December 31st because of the Christmas rush. Since there are liberal sales return policies, companies' operating cycles will begin after the Christmas buying season. And this allowance for returns takes into account sales that were made in one period which may be returned in another. And the same for sales price allowances. These can be agreements with customers instead of returning items to have a reduction in sales. My mom was always famous for going back with all our Christmas gifts right after Christmas and getting back a refund for the difference between the price she paid before Christmas and the sale price afterwards. Well, that's an example of a sales price allowance, and we'll talk about more about those in chapters 5 and 7. Next, we're going to present our cost of goods sold. And we have been using a very simple definition of cost of goods sold. That is the cost of the goods that were sold, but it's a little more complex than this. So what goes into the cost of goods sold? Well, we're going to explore this more in our next class in managerial accounting. And we will see that when we have costs that relate to manufacturing for the direct material that goes into a product, the direct labor, and manufacturing overhead, all of these go into what is called finished goods inventory, and finished goods inventory, when sold, those costs move into our cost of goods. The difference between our gross sales, our net sales, and our cost of goods sold gives us our gross profit. Gross profit is an important item for users, particularly for manufacturing and retailers. A closely watched number will be our gross profit margin. The gross profit margin is calculated by taking the gross profit and dividing it by our net sales. So in 2011, the gross profit margin was 35.8, which is significantly down from 2010. But note that the sales amount has increased. Well, the reason this company was not more profitable as measured by the gross profit margin is that the cost of goods sold grew disproportionately. So we're going to present our income statement in a way that allows our users to make these types of analysis. So the presentation in the multi-step begins with the calculation of gross profit.